Welcome to our recap. U.S. equities faced a broad sell-off on Tuesday, primarily driven by escalating geopolitical tensions in the Middle East and renewed inflation fears. The benchmark S&P 500 concluded the day down 0.9%. The Nasdaq Composite slid 1%, and the Dow Jones Industrial Average finished 0.8% lower. The Cboe Volatility Index, often called the Fear Index, surged to a 3-month high, reaching an intraday peak of 27.30, reflecting increased market anxiety. While there was some intraday recovery, the initial sharp declines highlighted investor apprehension. The sell-off was exacerbated by a plunge in South Korea's KOSPI index, which triggered a significant tumble in U.S. chip stocks like Nvidia, Qualcomm, Advanced Micro Devices, and Broadcom, all closing deep in the red. This market reaction does not resemble a typical flight to safety, as even traditional havens like gold and U.S. Treasuries experienced declines amidst rising dollar and oil prices. Deutsche Bank suggests that geopolitical events usually don't cause sustained market reactions unless they lead to a significant sustained oil price spike or a hawkish shift from central banks. Several public companies experienced notable stock movements. Plug Power surged 14% and later reported a 23.2% gain after its Q4 earnings beat revenue expectations, showcasing approximately 13% year-over-year revenue growth and a dramatic gross margin improvement from negative 122.5% in Q4 2024 to positive 2.4% in Q4 2025. The company reported a record $187 million in electrolyzer revenue for 2025 and highlighted an $8 billion global sales funnel, with the new CEO reiterating targets of positive EBITDA by Q4 2026 and full profitability by the end of 2028. Pinterest jumped 7% following the announcement of a $1 billion investment by affiliates of Elliott Investment Management. Pinterest plans to use these proceeds for a $1 billion accelerated share repurchase agreement, part of a newly authorized $3.5 billion buyback program. Including prior repurchases, the company anticipates total share buybacks to reach approximately $2 billion in the first half of 2026. Target shares rose 4% after issuing an upbeat fiscal year 2026 outlook, projecting net sales growth of approximately 2%. The escalating conflict in the Middle East, specifically the U.S.-Israel strikes on Iran and Iran's retaliatory actions, has been the primary driver of market uncertainty. President Donald Trump's hints at a prolonged U.S.-Israel campaign and his refusal to rule out putting American boots on the ground have fueled fears of an extended conflict. The conflict has disrupted shipping through the Strait of Hormuz, a crucial route for 1/5 of the world's oil and natural gas, leading to a spike in oil prices and concerns about global supply chains. President Trump's commitment to escort oil tankers through the Strait of Hormuz and provide insurance for regional maritime trade briefly eased some oil price gains, but Brent crude still ended the day higher. Economists warn that a protracted conflict could push inflation above 3% for the first time since early 2024, exacerbating affordability concerns for Americans. The Supreme Court's recent ruling invalidating a substantial portion of Trump's tariff regime under the International Emergency Economic Powers Act also adds to policy uncertainty, though the administration is seeking alternative legal authority. Commodity markets have reacted sharply to the geopolitical developments. Crude oil prices, both U.S. benchmark and Brent, saw significant increases, with U.S. crude rising over 5% to $75.22 per barrel and Brent surging 8.7%. Natural gas also rose over 3% on Tuesday due to increased supply risks. This surge in energy prices has rekindled inflation fears, leading to a broad sell-off in government bond markets globally. The U.S. 10-year Treasury yield rose nearly 7 basis points to 4.1%, reaching its highest level since mid-February, as inflation worries outweighed demand for defensive assets. Gold prices, typically a safe haven, initially dropped over 3% after a 4-day rally, as a stronger U.S. dollar and rising inflation concerns dampened demand. However, some analysts still favor gold as an attractive hedge due to geopolitical risks and central bank demand, projecting it could climb as high as $6,200 per ounce by mid-year. Copper and other base metals declined as traders adopted a cautious stance ahead of key policy signals from China. The U.S. dollar strengthened, hitting multi-month highs against the euro, sterling, and yen as geopolitical tensions fueled demand for safe haven assets and pushed back expectations for Fed rate cuts. Bitcoin also sold off, dropping almost 3% on the heightened global tensions. Looking ahead, investors will closely monitor the ongoing geopolitical situation in the Middle East for any signs of de-escalation or further intensification, which could significantly impact oil prices and inflation expectations. Several key economic data announcements are scheduled for the coming days. The U.S. ADP employment report on Wednesday, March 4th, followed by the U.S. ISM services data and U.S. DOE crude oil inventories later the same day. Investors are also highly anticipating Friday's jobs report, which will offer further insight into the labor market's trajectory and influence Federal Reserve interest rate policy. Markets have pushed back expectations for the next Fed rate cut to September from earlier forecasts of July, though 225 basis point reductions remain priced in for 2026. The Federal Reserve also has several scheduled events throughout March 2026. The Q4 U.S. GDP annual growth rate, secondary estimate, and Producer Price Index, PPI, are also due next week. From a technical perspective, the S&P 500 is currently trading at a 7% discount to its composite fair value, with small-cap stocks remaining the most undervalued. Morgan Stanley suggests that current tensions are unlikely to fundamentally disrupt the prevailing bullish momentum, with historical data showing average S&P 500 gains after geopolitical shocks, unless there's a significant and lasting jump in oil prices.